Hi everyone, I'm Andrew Martin. I'm here with Stuart Welch. We are portfolio managers for the Australian domestic equity portfolios. Today we're going to be taking you through the recently completed reporting season. Now, reporting seasons are always interesting and surprising in their own ways, but I think this reporting season, and indeed the last one, probably provided a few unique challenges to portfolio management. And this one was exacerbated a bit because we were bookended by, on one end, AI is going to eat software and a whole lot of other industries, and on the other end we had a war breakout, which has created its own issues. I think that probably the two biggest things you're going to hear from people around this reporting season was that it was volatile, and that is true, and that it was very large cap skewed. Both those things are absolutely true, but I think that actually potentially misses out on the fact that if we look at page 2 of this presentation, just how strong this reporting season was. In fact, it was one of the strongest reporting seasons we've had in not just years, but potentially in decades. Yes, it was volatile again, but what we would say is that it was volatile in the right direction. In other words, if stocks beat or got upgrades, they tended to go up, and if they missed or got downgrades, they tended to go down. That's actually very normal. Now, the quantum was different, and we'll go through that a bit later in the presentation. But at least directionally, the volatility was in the right direction. And what that meant was we got earnings upgrades in the market, around 2% overall, and that led to the market going up around 4% as the market got a bit more confident about the underlying fundamentals of the earnings in the business, in the market. Now, this is really positive actually for the market, because the market had been pushing on pretty strongly. The PE was getting high. We actually needed a bit of earnings to come through, and so having this really strong reporting season from an earnings perspective is very good for the health of the market going forward. From an Alphinity point of view, our hit rate was very strong. We'll delve into that. It was 85% across the overweights in the portfolio, 100% in our top 10. And the other thematic we'll talk about is momentum. Now, the things that worked in this reporting season were actually the same things that were working before. We had a big rotation into resources at the end of last year. Banks were doing well, which I'm sure you've heard about. Those were the same things that were working into this reporting season. And that's the definition of momentum. Things that were working are likely to keep working and likely to keep working going forward. But it's important to know that earnings was ultimately the driver of that momentum. Before we delve into details, Stuart's just going to take us through a little bit about why earnings matter and why we care about earnings and why it drives share prices. We'll then delve into detail about reporting season and finish up with just how we position to take advantage of what's going on in reporting season. So over to you, Stu.
Thanks, Andrew. So just on slide 3, we have a few slides that run us through the Alphinity process. And while this might look a little bit elementary, sort of breaking down prices and highlighting that they're driven by both earnings and then a multiple that people are prepared to pay for those earnings, it's an important focal point for where we focus here at Alphinity. And we do focus on that earnings piece. So we are looking for reasonably valued quality businesses that are delivering earnings ahead of expectations. And we think earnings is the right key focus, because it's something that is prone and open to very rigorous research, something you can focus on, something that's much more tangible compared to something like the PE multiple, which is much more driven by investor sentiment, interest rates, flows, alternative investments, and where they might be moving. We find earnings the right thing to focus on, as it is something that's very tangible. If you move over to page 4, another piece of information that sort of really informs our focus on earnings is that earnings do drive share prices. It is so fundamental, and here what we're looking at is a chart of the aggregate level of the ASX index relative to the aggregate EPS earnings for the index, and you can see over time that earnings do drive the overall level of the market and share prices. We also put this in here just to highlight the very last piece of that chart, the last few years, where you can see that it does deviate, and where that line deviates, it's typically it is a change in the price earnings multiple that people are prepared to pay for earnings. And you can see over the last 3 years that the aggregate level of earnings for the market has actually been negative. We've actually had earnings go backwards. At the start of each of those 3 years, we've expected earnings growth in the mid to high single digit range, and ultimately delivered negative earnings growth. Yet the market kept pushing on, driven by what was happening in the US, whether or not it was the tech companies a global easing cycle, AI. The market kept moving on despite that. And so that PE multiple kept expanding, and it did leave the market quite vulnerable. But what we have seen, particularly since the fourth quarter of last year, is very strong earnings growth coming through, particularly driven by the resources sector, and we'll touch on that as we go through. On page 5, this is probably the best depiction of our investment philosophy and process. As I mentioned before, we talk about investing in earnings leadership, which is investing in those companies delivering earnings ahead of expectations and getting earnings upgrades. We want reasonably valued quality businesses in that earnings upgrade cycle. And that's driven by 2 core beliefs here at Alphinity, and that is firstly that earnings drive share prices, as we've been talking about, but importantly it's the changes in earnings expectations. At any point in time, the share price should reflect the expected future earnings stream, and what we want to do is invest in those companies where those expectations are going up. And typically what we do is see the share price follow. And importantly, that investing in companies at the right point of their earnings cycle avoids 2 of the most common pitfalls of investing. And as you can see on the right-hand side of this clock here, the growth trap and the value trap. And so this is the lens through which we look at companies. Either analysts are too pessimistic and having to upgrade their numbers, and that's on the left-hand side of the chart, that's where we like to invest, or they're too optimistic and having to downgrade expectations on the right-hand side. And this is where we see those 2 most common pitfalls, the growth trap and the value trap, where either a company has very high expectations and is missing on earnings, and you're getting both earnings expectations and the PE multiple contract, or a stock screens as cheap in the value trap bucket. But the price is reflective of the earnings risks and outlook there, and often what you typically see is further earnings downgrades capping any upside. So we want to be on that left-hand side. And the second core belief we have here at Alphinity is those earnings upgrades are serially correlated. So typically, for a whole bunch of confluence of fundamental and behavioural factors, we often see that these earnings upgrades eke out over time. Very rarely is it one and done. And so the earnings upgrade actually increases the probability of a second, third and fourth earnings upgrade, and that's when we like to invest in companies.
Yeah, I think that's really important because as I spoke at the start about what was performing in reporting season, it really is that serial correlation continuing from that rotation to last year. If we turn to page 6 now, let's just do a bit of rapid fire through reporting season and some of the main thematics there. I mentioned that it was one of the strongest reporting seasons we've seen in a long time, and this just puts it into context. So the top chart just shows earnings upgrades versus downgrades. If the bar is above the line, that means we're getting earnings upgrades. Below earnings downgrades, you can see on average you get earnings downgrades in reporting seasons. This one, the bar right at the end is showing the latest reporting season, and outside of the sort of government boost-induced pandemic bounce we saw there in 2021, this is the best reporting season in terms of earnings upgrades for 25 years. Now that's really important again for the health of the market. It is driven a bit by the fact that it's large cap skewed. So if you look at the bottom chart, you can see this is the number of beats versus misses, if you like, and that sort of takes away the market cap skew. It again, outside of the pandemic, shows you that it's one of the strongest reporting seasons that we've seen in not just years but even decades. So that's again really positive to remember, given all the talk about volatility. Underlying, it's still actually very, very strong. So if we turn to page 7, which just takes us through that a bit more detail about where those beats and misses came from, just to give us a sense of what was driving things. And the top chart you can see here shows that what was driving the beats and misses wasn't beating in sales. Sales typically came in about expected, slightly better, but typically around what people expected. The key driver was around margins. Companies were just managing their earnings, managing their cost base really well, and that saw the beat come through. Now, in the context of AI, we're not seeing a huge benefit just yet. Some companies are seeing it, but looking forward, certainly a lot of discussion around AI and the potential benefit from a cost base, and therefore the ability to control margins going forward looks potentially even better, particularly in a number of sectors, and we saw a number of companies announce layoffs and what have you. So I think that margin beat potential is looking good going forward. And the very last one on that page, just showing if you break the market down into its constituent bits, where the beats and misses were coming from. overall, and we can see it's pretty much across the board, whether it's cyclicals, defensives, resources, wherever, except for growth. And that's really important because the growth companies, these are tech companies, healthcare companies, tend to have high expectations, high PEs, and when you miss your earnings, you tend to get an outsized downside negative impact. Because not only do you get earnings come down, but the PE, the multiple applied to those earnings also comes down. So that's worth keeping in mind when we just look at the next page on page 8, which is around the volatility in the market, which, as we know, is true. It was volatile. This shows, going back the last 10 years, each reporting season, and it's a measure of volatility, the one-day reaction to either beats or misses. So beats are the blue bars, misses are the more beige bars. And you can see the last column being the current reporting season, why people thought it was volatile, largely because of the downside. So you can see if you missed earnings, it was quite a large one-day average downside move, exacerbated, I think, by where the downgrades came from in growth, as well as some structural reasons, which I'm sure you've seen in the press. On the upside, it was slightly better than normal, but not massively better than normal. So I think when people talk about the volatility, it's more thinking about the negative reaction to misses that really came through quite strongly in this reporting season.
So on page 9, we look at those earnings upgrades and disaggregate them by sector. So it's a reasonably complex chart, but the red line is the combined figure. So that's whether or not the market was getting earnings upgrades and downgrades. And as you can see, for the vast majority of the last few years, we've been in earnings downgrade mode. Although since the fourth quarter of last year, we've been in earnings upgrades, and it's really been driven by those grey bars, which is the resources sector, getting material earnings upgrades with just better than feared demand for commodities and some supply issues and a weaker US dollar all supportive. The other interesting piece to pull out here is the lime green bars, which have been, other than a brief hiatus in first half 25, in pretty consistent earnings upgrade mode, and so that is primarily the banks in more recent times. And so we have been in that sort of earnings upgrade mode over the last sort of 5 months or so, which was a big change from where we'd come from. But what we saw coming through February was a continuation of that theme. So there was no major change in earnings leadership over February from what we've seen since the fourth quarter of last year. On page 10, we just look at what that's driven in terms of share price performance and then disaggregate that by whether or not it's been driven from underlying earnings or whether or not it's been driven by a change in the price earnings multiple. And you can see, given the two strongest sectors were both the resources and the financials, that they were the key drivers of share price performance over the month. And it was through a combination of earnings upgrades and PE expansion as well. And that's often what we see, is when companies are delivering earnings ahead of expectations, getting earnings upgrades, the market gets more confident with them and starts to ascribe a higher PE multiple. Although our focus is very much on the earnings piece, often you see the PE multiple come along for the ride. And on the right-hand side of the chart there, you can see some of the laggards that suffered a really material PE contraction were certainly in the healthcare and the technology side, where we had a number of companies miss and also have that PE downgrade, partly because of the earnings, but also because of that AI overlay. And we sort of touch on that on page 11, where we look at a combination of stocks. These aren't just tech stocks, these are stocks also from communication services and healthcare as well, but all companies with a large tech exposure. And you can see the relative performance of some of these stocks over the period, some of which was driven by earnings, but it was also that AI overlay where we saw a lot of a rapid acceleration in the ability to develop software, which has led to some question marks about the sustainability of some of these business models, which will likely go unanswered for some time at this point. But it certainly has people questioning the length or the sustainability, the durability of some of these franchises, how long that growth can continue, and certainly pondering what is the right terminal value for some of these sort of businesses. On page 12, one of the other thematics we saw was really large caps outperforming small caps. And what this chart does is it looks at the equal weighted index relative to the actual index, which is weighted by the size of the company. And where this line is going down, large caps are outperforming small caps. And that certainly happened over the February to the tune of almost 7%. driven by the really strong performances from resources, and in particular the large diversified miners, BHP and Rio, and also the banks. All four major banks outperformed very strongly during the period. The only real exception we saw was in the healthcare space. CSL was probably the only company in the top 10 to actually get earnings downgrades over the period. And Cochlear and Pro Medicus also had earnings downgrades. And so we saw some pretty material underperformance from the healthcare sector, which was a continuation of what we saw in August last year.
And you can see that on page 13. It is important. We are larger cap skewed here at Alphinity, so that was certainly helpful for us. And you can see, as I mentioned earlier in the presentation, we had a very strong hit rate across our business. These are companies that didn't miss. These are companies that didn't get downgrades. We had an 85% hit rate across the portfolio, 100% in our top 10, helped by the fact that large cap certainly did well. I'm not going to go through all the companies on this page, but you can see the key beats that we had there. Things like A2 Milk, concerns going into the result, did much better, got the bounce. Woolworths with its turnaround, QBE, much steadier result. The banks, BHP, these are important large companies that did very well. But the key, as well as getting things right, is missing the things that go wrong. And so missing the bombs in the market, which you can see the list there, and our hit rate on getting the right stocks was positive, and the hit rate on missing stuff was also very good. And both those things have helped performance through that period. On page 14, we've spoken a lot about the fact that yes, it's been volatile, but things have moved in the direction you would expect. And what we've done here, I'm sure it's hard to read some of the names on the charts, but what we've done here from a portfolio perspective is just the blue dots are companies that either beat or got upgrades, the red dots are things that missed or got downgrades, and then we've mapped the performance of all those stocks over February from their result to the end of February. And it's exactly what we would expect, which is if you've got companies right from an earnings and upgrade perspective, the blue dots, they outperformed. If you've got them wrong from a red dot perspective, they underperformed. So yes, volatile, but volatile in the right direction.
So on page 15, we have a chart of the EPS revisions of our portfolio relative to the broader index. So what this chart shows is for any calendar year, whether or not our portfolio got more earnings upgrades relative to the index. And so if you go back to that equation at the very start that I showed you, it would imply that the earnings component of that equation is increasing faster than the market. And you can see here that we've got off to a good start in 2026, and we've been able to do that since inception, find stocks that are getting those earnings upgrades. Importantly, this obviously is over a very large length of time and a number of different market environments, and so it speaks to the inherent flexibility within the investment philosophy and process to go to wherever that earnings leadership is and to invest in those companies that are getting those earnings upgrades continually over time. We don't focus on the PE, but as we've sort of demonstrated as on the way through, that often if you are in the companies that are on top and getting those earnings upgrades, ordinarily you see the PE multiple also come along. And then we sort of jump in on our positioning on page 16 there by sector. This is very much an output for us. Like we are a bottoms up sort of focused organisation looking for companies that are getting earnings upgrades. So this is very much an output, but it's very helpful to try and understand where we are positioned in the market at the moment. No surprises that the two key sectors you can see here are the banks and the miners. That's where the earnings leadership is today. That's where the earnings upgrades are coming through. But importantly, I think that we also are very well represented in most other sectors as well. Even in sectors that are getting earnings downgrades in aggregate, we can often find some idiosyncratic story as to why an individual company might be getting an earnings upgrade. And that's ultimately what we aim to do, is have a balanced portfolio of companies that are all getting earnings upgrades. And then on page 17, we have our top 10. Again, no surprise that there's quite a few from the materials and the financials sector represented there. But we do also have staples, REITs, insurance companies as well in the mix, and we do aim to have that balanced portfolio of companies getting earnings upgrades.
So thank you for your time. Certainly not getting any easier in the markets, certainly with the war ongoing, but I think encouraging for us through reporting season, even though it was volatile, is that earnings continue to be the driver for share prices. And we think not only have we seen that happen this reporting season, it typically happens in other reporting seasons, and we think it'll continue to be the main driver going forward. So thank you for your time.